Welcome again, dear students and scholars. In video 1, we built the boundary map, passive investment, significant influence, and control. Now we move one level deeper. In this video, the main question is simple but powerful. What if the investor does not hold ordinary voting common stock? Maybe it holds preferred stock, options, warrants, or a special agreement. Does the legal label decide the accounting? Under US GAAP, not necessarily. ASC 323 asks what the interest really does. So today we are going to look past the name tag and examine the economics underneath. Because in accounting, labels are useful, but they do not get to do the whole job by themselves. In substance, common stock means an investment that may not legally be common stock, but economically behaves like common stock. That is the key idea. If the interest shares common stock style risks and rewards, and the investor also has significant influence, the equity method may still be relevant. But notice the two-part test here. Equity like economics alone are not enough. Significant influence must also exist independently. So the question is not only does this instrument look like common stock? The question is also does the investor have practical ability to participate in the investee's policy decisions? ASC 323 uses three economic tests to help us judge substance over form. First, subordination. Does the interest rank like common stock in the capital structure? Second, risks and rewards. Does it share upside and downside with common shareholders? Third, transfer of value. Does it receive special value that common shareholders do not receive? These tests work together. We should not pick our favorite test and ignore the others. That would be like checking only the front door of a building and declaring the whole building secure. In accounting analysis, every important entrance needs attention. The first test is subordination. Common stock is normally the most subordinated ownership layer. It bears residual risk after more senior claims are satisfied. Debt is usually paid first, preferred interest may sit in the middle, and common stock is last in line. So, if an instrument has strong liquidation preferences, fixed repayment features, or downside protection that common shareholders do not have, it may not behave like common stock. The closer the interest sits to common stock in the risk ladder, the stronger the case for in substance common stock. The more protected it is, the weaker the case becomes. The second test asks whether the interest shares the same risks and rewards as common stock. Common shareholders usually participate in earnings growth, enterprise value appreciation, and residual upside. They also suffer when the business loses value. So, an equity like interest should participate in both good news and bad news in a similar way. If the return is fixed, guaranteed, heavily capped, or shielded from losses, then it starts looking less like common stock and more like a protected financing arrangement. A common stock like instrument should not only smile when the company performs well, it should also feel some pain when the company struggles. The third test focuses on transfer of value. An interest is usually not common stock like if the investee is expected to transfer substantive value to that investor while common shareholders do not receive a similar benefit. Common examples include mandatory redemption, a put option at a non fair value premium, or guaranteed return protection. The key is substance. If the arrangement effectively gives one investor a special exit or special value transfer that common shareholders cannot access, the instrument may fail the common stock comparison. A single failing test can be enough. In other words, one big protection feature can ruin the common stock costume. Preferred stock is a perfect example of why legal form alone is not enough. Some preferred stock may participate in earnings and residual value in a way that resembles common stock. Convertible preferred stock may track common stock value because of its conversion feature. But mandatory redeemable preferred stock may include a protected exit value, making it much less common stock like. So we should never say preferred stock always qualifies or preferred stock never qualifies. The correct answer is analyze the terms. The word preferred is the beginning of the question, not the final accounting conclusion. Options and warrants also require careful analysis. Holding the right to buy common stock in the future is not the same as currently holding common stock like economics. We need to examine exercise rights, timing, barriers, restrictions, economic exposure, and current policy influence. Does the holder participate today in gains and losses or only potentially in the future? Can the holder currently influence operating or financial policies, or is the instrument just a right waiting in the drawer? Potential ownership can be important, but potential is not the same as present economic substance. Sometimes the legal instrument is not a share at all. A licensing agreement, management contract, funding arrangement, or other contract may create ownership like economics. The analysis asks whether the arrangement gives variable returns tied to the investee's performance and whether the investor has practical ability to participate in policy decisions. Fixed fees alone usually do not create common stock like economics. But if the contract gives exposure to gains, losses, residual value, and decision participation, then ASC 323 may need to be evaluated. Again, the document title is not the answer. The economics are the evidence. Let us apply the idea with Nova Labs and HelioTech. Nova Labs acquires participating preferred stock in a renewable energy company. The shares rank close to common stock, have no material liquidation preference over common holders, and returns vary with HelioTech's earnings and enterprise value. Nova Labs also has a board seat and participates in budgets and strategy. This points strongly toward in substance common stock, and significant influence is also present. So, an ASC 323 equity method evaluation is appropriate. This case is a good reminder that preferred stock can be equity like when the economics truly follow the common shareholders. Now compare that with Apex Fund and RiverGrid. Apex acquires preferred units with a mandatory redemption clause at a fixed premium. Apex also receives a protected minimum return even if common unit holders perform poorly. Common shareholders do not have similar downside protection or guaranteed exit value. That is a major problem for the common stock comparison. The arrangement gives Apex special value that common holders do not receive, so it likely fails the transfer of value test. The conclusion is that the interest is likely not in substance common stock. Protection is nice for the investor, but it can be dangerous for equity method qualification. The conclusion about in substance common stock is not always permanent. Reassessment is needed when something changes the economics of the instrument or the investor's influence relationship. For example, contract terms may be amended, redemption rights may be added, return structures may change, the investee's capital structure may be recapitalized, or the investor may acquire an additional interest. These events can change subordination, risk and reward exposure, or transfer of value analysis. So, the original conclusion should not be treated like a museum artifact. If the facts change, the accounting team needs to revisit the analysis. But poor performance by itself is not a reassessment trigger. This is a common misunderstanding. If the investee reports losses, that does not automatically mean the interest has stopped being in substance common stock. Losses are part of the risk profile of common stock like economics. They affect the carrying amount through equity method accounting, but they do not automatically change the instrument's substance. Losses affect value, they do not automatically change identity. A rainy day does not turn an umbrella into a boat, and an investee loss does not automatically turn a common stock like interest into something else. Once the equity method begins, the usual starting measurement is cost. That cost becomes the anchor for later equity method accounting. Future adjustments, such as the investor's share of investee income, dividends received, basis differences, and impairment, all build from this starting number. This is why the initial measurement matters. If the starting point is wrong, every later roll forward becomes harder to trust. So at the entry point, we ask, what did the investor give up to obtain this equity method investment? And what is the proper initial carrying amount under the applicable guidance? There are narrow situations where the equity method investment may start at fair value rather than normal acquisition cost. One example is a retained interest after deconsolidation, where a parent loses control but keeps an equity interest. That retained interest may be remeasured to fair value at the date control is lost. Another example can involve receiving an equity interest in connection with derecognition of a distinct non financial asset. These are not the default rules for every equity method investment. They are specific entry points created by other guidance. So remember, cost is the usual anchor, but some transactions bring fair value into the doorway. Contingent consideration needs careful treatment. An equity method investment agreement may require the investor to pay additional amounts if future events occur. But we do not automatically add every possible future payment to initial cost. First, ask whether another ASC standard requires recognition at inception. Second, ask whether the arrangement creates a present obligation that meets the definition of a liability. Third, if a liability is required, determine whether ASC 323 limits the measurement. This is a gate, not a shortcut. Possible future payments should not casually walk into the investment account without analysis. When contingent consideration is recognized as a liability, the measurement can be capped. The recognized liability is the lesser of two amounts. Input A is the excess of the investor's share of investee net assets over initial cost. Input B is the maximum unrecognized contingent consideration. The recognized liability is the lower of those two amounts. The purpose is to avoid recording a liability larger than the economic support. This is one of those rules where the word lesser is doing serious work. It is small, but it can save the financial statements from becoming overexcited. Now bring the analysis together. Before ASC 323 can apply, two independent gates must be cleared. The investor must have significant influence, and the investor must hold common stock or in substance common stock with no applicable exclusion blocking the model. Significant influence is the policy gate. In substance common stock is the instrument gate. If either gate fails, the equity method does not apply at that stage. This decision tree is especially useful in complex instruments because it prevents us from jumping to the answer just because the ownership percentage or instrument label feels familiar. Here is the exam trap. The question says preferred stock, and the learner immediately concludes that ASC 323 cannot apply. That is a form over substance mistake. Preferred stock may or may not be in substance common stock depending on its terms. The better approach is to apply the three economic tests: subordination, risks and rewards, and transfer of value. Then separately assess significant influence. Only after both pieces are analyzed should we reach the accounting conclusion. On exams, the best answer often rewards the learner who slows down for the terms instead of racing toward the label. In the next video, we finally start the core equity method engine. We will move from entry point analysis into journal entries, recording the initial investment, picking up the investor's share of investee income, treating dividends correctly, and reconciling the carrying amount. If this lesson helped you see why legal form is not enough, please like the video, subscribe to Commerce Regiment, support the course, and share it with your colleagues who are learning US GAAP. Your support helps this channel keep building clear, practical accounting lessons. I will see you in ASC 323, Video 3, where the equity method numbers begin.